Hello and welcome to our latest Insider interview. I'm Kyle Caldwell, and today in the studio I have with me Sebastian Lyon, who is fund manager of the Trojan Fund and Personal Assets Investment Trust. Sebastian, thanks for coming in today.
Kyle, thanks very much. It's a pleasure to be here.
So Sebastian, Troy Asset Management, it's known for its cautious investment approach. So how are you approaching at the moment the so-called Magnificent Seven stocks that have dominated stock market returns since the start of last year?
So, well, Carl, we've been in an extraordinary time from the point of view of growing assets and protecting assets, which is obviously our aim, when we've effectively been in a boom. I think that's pretty uncontroversial. We've been in an generative AI-driven boom, an investment boom. A lot of these companies, the Magnificent Seven, have been investing for that prospective boom, which will happen further down the line. We hold Microsoft and Alphabet. We've had an exposure to both those companies. We bought Microsoft back in 2010. It's been an amazing investment for us. And we've also bought Alphabet in 2019. So we do have an exposure to that area. Clearly, there's been a huge concentration of return, and the size and scale of these businesses affects the markets on a daily basis. So I think something like 30% of the US stock market is derived from those seven stocks today. And when you have concentration like that, generally speaking, you should be wary. That's not necessarily a good sign of a healthy stock market. Now, that has been driven not entirely by pure speculative reasons. It has been driven by huge profitability and huge growth in earnings, particularly, for example, with Microsoft, with the growth of its cloud business on Azure. And that's going to benefit from AI as time goes on as well. And generative AI is going to, we think there are going to be genuine benefits to generative AI in the future. The problem is that when you have these booms, there are hiatuses where there's a question of, is it going to deliver? When is it going to deliver? And markets extrapolate and they get excited, and then you have periods of fallback, and then you have the subsequent growth from that investment. And we're possibly going into a period like that at some stage in the future, and that's what we would be concerned about. A little bit like the dot-com boom, but I think there are differences. It's very easy to make comparisons, but in the dot-com boom, if you remember, there was huge optimism, then the pessimism that the growth didn't come through, and then ultimately the Amazons and the Googles, etc., produced huge growth subsequently after that. And my fear is that we may go into one of the hiatus periods at some point in the future, but at the moment, clearly they're driving investor returns. Having said that, it's not just about the Mag 7. And while we have had great returns in the Alphabets and the Microsofts this year, we have also had good returns in, seen as quite pedestrian businesses like Unilever, which has done very well for us, which 2 years ago everybody hated, and American Express as well. So it's not just been about those seven. Clearly the S&P 500 returns and the MSCI returns, the global returns, have been affected by the dominance of those businesses.
And those two big US technology companies that you've owned, Microsoft and Alphabet, have you been taking profits given their share prices have went up a lot in response to a lot of hype over artificial intelligence?
So we're always going to be careful about not allowing ourselves to get overexcited, not allowing to run things too hard. It's very tempting as an investor, and I know there are many investors who feel, run your winners, and you do want to run your winners and cut your weeds and run your winners to some extent, but there is a danger of running your winners too hard, and especially if valuations are increasing materially. And we have seen a very material increase, particularly in the valuation of Microsoft, actually, over Alphabet, still in low 20 times multiples, and is still executing incredibly well and generating very good growth. But with Microsoft, we have trimmed it a little bit this year. So we have been managing that risk. Careful not to get overexcited.
A stock that you don't own, which has performed remarkably well since the start of last year, is Nvidia. Is it a stock that you looked at all, and why don't you own it?
We've looked at it very briefly, and I think that this comes back to our whole investment process of how we go about generating returns with equities. And what we want, and I describe it as, it possibly sounds a little generic, but we want qualitative businesses, and we want to be paying sensible value, and we want to not have a great deal of cyclicality, because cyclicality can really kill performance. Leverage can kill performance, but cyclicality can kill performance as well. Nvidia has been a firstly, historically, it's been a phenomenal business and a huge success, particularly in the last 18 months. But it's also had its periods of huge cyclicality. It had a 90% drawdown during the dot-com bust. It had I think it's something like an 80 to 85% drawdown, a share price fall during the financial crisis. And then even recently in 2022, I think it was down 70% from peak to trough. Now, clearly it's been phenomenal now, but the reason for that is that it does have an IT hardware compared to IT software like Microsoft does have huge cyclicality. And that's why we would, for this mandate, this is about getting our investors to sleep at night and be comfortable. Owning a company like Nvidia, I would view that as inappropriate. And the other point to make about the business is that I think 50% of its revenues are accounted for by 3 of its largest customers. So it's actually, think about how many millions of customers a company like Microsoft has compared to 3 customers that Nvidia has. So the risk of those customers stepping back on their capex, changing, they're desperate to find another provider of chips rather than Nvidia. So they would be very keen to diversify those purchasing if they could. So I think that those are the reasons effectively why Nvidia, and there's FOMO in Nvidia, there's huge FOMO, which I think in stock market terms, FOMO can be a very dangerous thing, fear of missing out. And I get the sense there's real sort of, why don't you own Nvidia? Oh, we own Nvidia, that's great. I think we live in our own area, and we stick to what we know, and we know what's right for the portfolio in terms of equities, and we have a fairly strong view as to what we feel isn't appropriate, particularly for the multi-asset mandate where we're trying to protect. We're not trying to make people 20-30% a year. We're trying to protect the value of their investment and grow it, hopefully by 7 or 8, 9% a year.
And of course, you invest for the long term, so you don't often make changes to the equity holdings in either the fund or the investment trust. Having said that, could you run through portfolio activity, perhaps over the past year?
So over the last year, we've made 4 changes really to the portfolio, the equity part of the portfolio. We sold 2 holdings and we bought 2 holdings. So last December, we sold Franco-Nevada, which is a gold streaming and royalty business. And we sold that very much because of, frustratingly really, because it had been a great investment for us since 2017. Your point about we invest for the long term. We would still hold it today. There was one particular stock-specific risk, which it had exposure to one mine in Panama, which effectively was closed. We saw that coming actually, and we sold it down in 2022 and in 2023. In fact, interestingly, if things had been going well for it, the share price would be much higher thanks to the gold price going up. But we realized that there were actually stock-specific reasons as to why it wasn't going to benefit from those increases in the gold price. And actually the share price has fallen since we sold it last December. The other thing we sold, which is another long-standing holding we've had, is Becton Dickinson, which is the world's largest syringe manufacturer. And people always start shaking when I start talking about syringes. But it was a business which we'd owned since 2010. And really, we thought it was going to be a beneficiary of a post-COVID world, of people going back to hospital, having operations, that sort of thing. And it was a company that we were close to, and we really felt that it wasn't executing as well and delivering as well as we felt it should do. And sometimes you've got to recognize that the company that you bought 10 years ago, 15 years ago, for various reasons, whether it be M&A, whether it be changes of management, whether it be a different dynamic within the business, things do change. Businesses, human beings are sort of organic, have an organic form to some extent. And therefore, we've got to recognize when those changes happen. And for us, we just felt that change had happened and not necessarily positively. And we thought we could allocate our capital somewhat better than keeping Becton Dickinson. Again, we made money in it, but over the last few years, it had been pretty dull. And then we recognized as to why that was the case, and we thought we would move on. In terms of the 2 purchases we made in the summer, the first one was Chubb, which is the world's largest property casualty investor, property casualty company, insurance company. And what we felt with that was we were looking for businesses which were going to begin to benefit from a different interest rate environment. Coming back to your earlier questions about the interest rates and changes in interest rates. insurance benefits from that because they have a float, because they're investing that float, they're investing effectively the premiums every year. So in a higher interest rate environment, they're actually a beneficiary to that. So it comes down to the sort of top-down view and the bottom-up view of the fact that the business had a bit more of a tailwind than it has done hitherto. And also insurance, and we've owned insurance companies in the past. We've owned both Lloyd's insurance companies and we've owned Berkshire Hathaway in the past. And insurance is a sector where, to some extent, you need to be careful about, but nevertheless, we think it's excellently managed, and the returns have been very good over the long term. It's on a relatively low valuation, 11, 12 times earnings. And so we made a starter holding in Chubb. And then VeriSign, which is a company that's probably less well known, that owns .com and .net. So if you register an internet address with a .com or a .net, effectively you pay VeriSign a certain amount a year. It's about $10 a year. It's a very small amount, and effectively they hold the register of your domain name. And .com is by far and away the largest domain name in the world, and .net I think is the fourth largest. And so effectively it's like an internet utility, for want of a better description, and they can put their prices up by about 5% a year. And it was a company that was, it sums up the way that we go about investing to some extent. We're looking at these things year in, year out. It's not something we look at a company and buy it. We were looking at it over a number of years. The shares actually did very well during COVID. The shares re-rated very strongly. They were very expensive. And then from 2022 through to 2023 and into this year, the shares derated, became much more unpopular, went from 40 times earnings to 20 times earnings. And we thought actually at that sort of valuation, with the growth that we saw, that looked pretty attractive to us. So we bought a new holding in VeriSign as well.
You mentioned earlier that Unilever has been a strong performer. One of its peers that's not been performing well of late is Diageo. Could you explain your latest views on the stock? So,
well, you're right. You're right, Carl. It's been disappointing. As one private client fund manager said to me once, it's always, clients would always focus on the one that's down rather than all of the ones that are up, and that's definitely been the case with Diageo. Cast your mind back many years. So we've owned Diageo for 18 years, since 2006. Over that period, it's been a fantastic investment for us. So it's generated returns of about 360% in sterling terms, compared to the UK market of about half that, about 180%. So it's been a very, very good long-term investment. So that's one part of the story, and we've held it for that period, and we have reduced it over time and increased it over time as well. But it has been a core holding within the portfolio. COVID was obviously we know for many, many businesses, was a very bizarre period for the economy. We had a period where people couldn't spend on services, and so they spent on goods. Then we had the reopening. Everybody spent on services. Nobody spent on goods. In the case of services, everybody went out, unable to party. Suddenly everybody in 2022, 23 were able to go out to pubs and restaurants, etc. We had a huge boom in spirits, which is predominantly Diageo's business. And frankly, we are now seeing the other side of that. We're seeing the downturn that has happened, as demand has fallen back, has normalized. Frankly, the comparators, the comps, were very, very hard for Diageo in 2020, late second half of 2023, and the first half of this year, compared to the huge boom that we had really in 22 and the first half of 2023. Do I think the business is broken? No. We've got brands like Johnnie Walker, which have been around for, frankly, hundreds of years. People are going to be drinking Johnnie Walker in 10, 15, 20, 30 years' time. They will have pricing power. So I think this is a temporary thing. I mean, you compared it, actually, interestingly, to its peer within the UK market being Unilever. Unilever was, we had a lot of criticism about holding Unilever 2-3 years ago. We were adding to it back then. We have been adding to Diageo somewhat this year, gently, because frankly, I think that possibly it's going to get worse before it gets better, and you just want to not not be overly aggressive with your purchases if that's what you feel. I don't think it's out of the woods yet, but I think it will get out of the woods. I don't think it's permanently impaired. I don't think we're going to have permanent capital loss from Diageo, and I think it will turn. Things will settle down, and things will and earnings will recover. But I think this is. Ironically, we talked about not buying cyclicals. I mean, it's not a highly cyclical business, but I think it's probably more cyclical than I think people realised and remembered. I can remember back in the early 90s and late 90s, that period, there was a boom in spirits in the early 90s, particularly in Japan, actually. And then Guinness, which was Guinness and Grand Met, both had actually a pretty dull period through the mid-90s as that boom effectively faded. And the valuations of the companies came down, and the earnings growth was relatively flat. And then gradually, ultimately, it picked up again. And that's effectively, I think we're in a similar sort of period to that period. They will recover. When is the question? It may not be this year. Frankly, it may not be next year, but I think it will. So I think it's something that actually, as long-term investors, we want to lean into that negativity. The valuations come down a lot. It's not just been about earnings. It's been much more about the valuation of the stock. And I think ultimately the current valuation levels, you should make decent returns from here, there or thereabouts.
And finally, Sebastian, a question that we ask all 4 managers that we interview. Do you have skin in the game?
Most definitely I have skin in the game, Carl. So I've got a very material shareholding in personal assets, which is on the record. People can look at the report and accounts and see how big it is. And generally speaking, I buy shares every year in personal assets. But I also have holdings in our in-house funds, so in the Trojan fund and in global equity, etc. All of our funds that we manage at Troy. And I've also got a very material stake at Troy Asset Management itself. So I'm very aligned with our investors from that point of view. So I'm aligned every way.
Sebastian, thank you for your time today.
It's a pleasure, Carl. Thank you.
So that's it for our latest Insider interview. Hope you've enjoyed it. You can let us know what you think. You can comment, you can like, and do hit that subscribe button. And hopefully, I'll see you again next time.